Hello and welcome to this weekly Outlook video at xm.com. I'm Maria Bashardis, and joining me is Senior Investment Analyst Rafi Boyajian. We'll be discussing the week ahead. So Rafi, let's begin with Australia. We have the Reserve Bank of Australia's meeting coming up, as well as third quarter GDP numbers. What can we expect from the RBA next week, and how is the data likely to affect the RBA's decision?
Well, the RBA is expected to keep interest rates unchanged, but they have signaled that they're ready to cut further if needed, and analysts also are expecting that the RBA will have to cut rates further because so far, despite the three cuts they've delivered already, the inflation in Australia and growth remain fairly subdued. Now, there has been some talk in the markets that the RBA will have to resort to quantitative easing in 2020 as rates get closer to zero, and that has been pressuring the Australian dollar. So next week's data is going to be very important to give us a better idea of how well the Australian economy is performing, in particular how it did in the third quarter. The highlight will be the GDP numbers. We're expecting growth of 0.5% over the quarter. Now, that's not too bad if the numbers do come in as the forecasts suggest. But if we were to get any unexpected weakness in third quarter figures, that would only fuel speculation that the RBA will have to cut rates further and possibly resort to quantitative easing at some point in 2020.
I see. Moving to the Bank of Canada's meeting on Wednesday, what are the chances of a rate cut and how might that affect the loonie?
Well, we have been getting mixed signals from the Bank of Canada lately. At the October meeting, Governor Stephen Poloz said that they discussed making an insurance cut, but later on in another speech, Poloz sounded somewhat more neutral. So really don't know whether or not the Bank of Canada will cut rates if trade tensions were to escalate. Of course, trade tensions is the main risk that Poloz has pointed to in terms of downside risks for the Canadian economy. As for next week's meeting, we're not expecting any change in interest rates, but hopefully the Bank of Canada's policy statement will clarify its position as to whether or not as to the likelihood of a rate cut down the line.
All right. Turning to the U.S. now. Recent data has been upbeat. What are the important releases next week, and are we likely to get more positive data?
Yeah, we have been getting plenty of positive numbers out of the US, and we could get more of that next week from the ISM manufacturing and non-manufacturing PMIs, as well as the non-farm payrolls report for November. Now, we had seen some weakness in the ISM PMIs, both the manufacturing and non-manufacturing, but last month both ticked higher, and if that trend was to continue in November, then that would help the greenback extend the past week's gains. And we're also expecting a bit of a bounce back in jobs gains in November. Non-farm payrolls are expected at 183,000, a bit of an improvement on the prior month, and the wage growth will also come under the spotlight because despite the tight labor market, wage growth has remained stuck around 3% in the US. So if you were to see some acceleration there, that would be even more positive for the US dollar. And we have seen, of course, investors further scale back their expectations of a Fed rate cut as the US economy continues to outperform its peers, and therefore that's why we're seeing that renewed strength in the US dollar.
I see. And finally, regarding the OPEC Plus meeting on Thursday and Friday, it's widely expected that oil ministers will extend their production cut agreement until June. What will that mean for oil prices?
Well, oil prices have actually been doing fairly well over the past month, even though we're only expecting an extension, as you said, until end of June for the current output cap deal. So if that turns out to be the case, we're not expecting a huge reaction in the oil market, but there's a chance that they may extend further until the end of 2020. That would perhaps provide some support, maybe a bit of a lift to oil prices. But as things stand, if we were just to get simply an extension, it's unlikely to be enough to offset the oversupply for the oil market that's being predicted for 2020, and oil prices are likely to head lower soon as we start to see the impact of that oversupply, because at the moment there's very little appetite for deeper cuts. Saudi Arabia has been pushing for deeper cuts, but other countries such as Russia are against it.
Rafi, thanks so much for joining me, and thanks for watching at XM.com.